All right, let's talk charts. You ever look at a stock chart and it just feels overwhelming? Like you're trying to read some kind of secret code with all those lines and colors? Well, guess what? It is a language. And in the next few minutes, we're going to teach you the basics so you can start to understand exactly what the markets are saying.
Okay, let's jump right in. Quick test. Look at this chart. The price is trending up, it pulls back a little, and now it looks like it's ready to take off again. You know, the classic buy the dip setup. So the question is, do you buy here? It looks like a no-brainer, right?
Yeah, you'd think so. But nope, that trade would have been a total disaster. So why did it fail? Well, because right there on the chart, plain as day, was a hidden clue. A little warning sign that the upward momentum was fizzling out. Learning how to spot those clues, that's the real power of what we're talking about today.
A universal market language. You see, the method for finding these clues is called technical analysis. And the coolest part? It's a universal language. It doesn't matter if you're looking at a stock, a crypto coin, or even commodities. The charts speak the same language everywhere.
So what is it really? Technical analysis is basically the art of studying a chart's price action and volume. It's built on a couple of big ideas. First, that pretty much all known information, the news, the earnings, all of it, is already reflected or baked into the current price. And second, that markets move in patterns because human psychology, fear and greed, doesn't really change over time.
Now, it's super important to get this straight. This is not the same as fundamental analysis. That's when you dig into a company's balance sheets, its revenue, its debt, trying to figure out what the company is actually worth. Technical analysis couldn't care less about that. It's all about market sentiment and psychology. Think of it this way. Fundamental is the what and why. Technical is the how, and most importantly, the when. Okay, so if we're going to learn this new language, we need to start with the absolute basics, the alphabet. And in the world of charting, the letters are called candlesticks. If you can understand what just one single candlestick is telling you, you're already on your way.
And this is the perfect way to think about it. Each candle is a letter. A few candles together form a word. A group of them becomes a sentence. And those sentences are what tell you the story of what the market is doing and what it might do next. Every single candle, whether it represents 5 minutes or an entire month, is made of just 4 pieces of data. You've got the open price, where things started. You've got the close price, where things ended. The space between the open and the close gives you that thick part, called the body. And then you have the highest and lowest points the price hit during that time, which create those thin little lines called wicks.
And the shape tells you everything. A long, thick body, that shows conviction, a really strong push by either buyers or sellers. A tiny little body, that's indecision. The wicks tell the story of the fight. A long wick on the bottom means buyers saw the price drop and said, "No way," and pushed it all the way back up. A long wick on top, that means sellers rejected higher prices and slammed it back down.
Right, so now that we know our letters, we can start to form some simple words. These are key candlestick patterns that show up all the time and give us some pretty powerful hints about what's coming.
Let's kick things off with a fan favorite, the hammer. You'll often spot this one right at the bottom of a downtrend, and it's a great potential reversal signal.
So what does a hammer look like? It has a tiny little body up at the top and this really long lower wick. What's the story here? Well, it tells us that the sellers tried their best to push the price way, way down, but then a flood of buyers jumped in and drove the price all the way back up. They are literally hammering out a bottom for the stock.
Now, for every hero, there's a villain, and the opposite of the hammer is the shooting star. This pattern shows up at the top of an uptrend and warns of a potential reversal down.
The shooting star is basically just an upside-down hammer. Small body at the bottom, long wick at the top. It tells the exact opposite story. Here, the buyers tried to push the price to new highs, but the sellers stepped in with overwhelming force and said, "Not today," pushing the price right back down. It's a major red flag.
Okay, so we've got our letters, the candlesticks, we have some words, the patterns, now we need the grammar. We need something to help us build complete sentences and add context. That's where technical indicators come into play.
One of the most common and useful indicators is the moving average. All it does is plot a line on your chart that shows the average price over a certain number of periods, like the last 20 days. Its main job is to smooth out all the choppy day-to-day noise so we can see the real underlying trend more clearly.
So here's how you actually use them. In a strong uptrend, the price will often come down and touch the moving average line and then bounce right off it, like it's a moving floor. We call that support. In a downtrend, the price might rally up to the moving average and get rejected, like it's hitting a moving ceiling. That's resistance. Next up is something called VWAP. It stands for Volume Weighted Average Price, and you can think of it as a much smarter moving average. Why? Because it doesn't just look at price, it also considers volume. It gives more weight to price levels where a ton of shares were traded. So it shows you the true average price based on where the big money was active. The rule of thumb here is pretty simple. When the price is trading above the VWAP line, institutions and traders see that as bullish for the day. If it's trading below VWAP, that's bearish. A crossover of that line can be a huge signal that control is shifting from the sellers to the buyers or the other way around. And finally, let's talk about the indicator that would have saved us from that bad trade at the very beginning of this explainer, the MACD. It's a momentum indicator. Its entire job is to show you if a trend is getting stronger or weaker by tracking the relationship between two different moving averages. All you really need to know is this. It tells you if the trend's momentum is speeding up or slowing down. And the number one signal everyone looks for is called the crossover. Remember that chart from our quiz? Just as the price looked perfect, the MACD lines crossed. That was our secret clue. It told us that behind the scenes, momentum was shifting to the sellers right before the floor fell out.
So, let's recap. We have the letters, we have the words, and now we have the grammar. Let's put it all together and see how these tools work in combination to tell us a full, complete story.
Okay, let's walk through an example. A stock is flying high, printing these huge, confident green candles, strong buying. But then, right at the very top, a shooting star appears. That's warning number one. Our alphabet is talking to us. Then, the price drops and breaks below its key moving average. That's warning number two. Our grammar is showing a crack in the foundation. And finally, the MACD has a bearish crossover. That's the confirmation. It's not one single clue. It's all of them together telling a powerful story of a trend that's about to end.
Look, reading charts isn't about predicting the future with a crystal ball. It's about learning the language so you can understand the probabilities and the story the market is telling you right now. So the next time you pull up a chart, don't just see a bunch of random lines. Try to see the letters, the words, the grammar. Try to read the story. The only question left is, what is it telling you?